So the commonality between multi-asset strategies is really that they all surround the idea of an objectives-oriented outcome. So this is in contrast to more traditional strategies which target relative return, and it really surrounds the idea of optimizing a portfolio against a specific outcome rather than a specific target benchmark. So outcomes include things like income, include things like growth, include things like capital preservation, and it all surrounds the idea that outcomes is what matters, and folks cannot eat relative returns, and therefore we should be optimizing portfolios towards outcomes rather than just beating benchmarks. So we've seen multi-asset solutions fit in different contexts within different portfolios. The most extreme of which is the most sophisticated investors are now moving their entire portfolio construction process to the idea of objectives-oriented. Now this is a very select few that are moving in this way, and it's primarily on the institutional side that you see this dynamic happening. What you do see more commonly across most portfolios is that multi-asset is being used in a couple of different ways. One is used as an alternative, so as a diversifier to more traditional asset allocation. The second is as a replacement for either a capital preservation asset such as fixed income or a replacement to equity when we're talking about growth multi-asset. So there are multiple ways to use multi-asset. It's all dependent on the framework which is adopted by the investor themselves and how best to blend multi-asset within the broader picture. The benefits for multi-asset strategies really come in the form of improved portfolio efficiency. So what we mean by that is either a reduction in volatility for the same level of return or an increase in the level of return for the same level of volatility. So that's the primary benefit from a risk-return standpoint. At the portfolio level, multi-asset strategies more broadly target a higher Sharpe ratio than traditional static asset allocation. So the primary benefit is lowering volatility, enhancing returns, and finally the other benefit is really managing the sequencing risk associated with investing at a specific time point. So there are a variety of ways in which multi-asset strategies seek to achieve higher returns with lower volatility and seek to achieve growth-oriented objectives while limiting the downside. These would include things like long-short strategies, which seek to exploit risk premia. These strategies do employ leverage, but these risk premia tend to have higher Sharpe ratios than more traditional asset classes. This also includes strategies that use quantitative techniques to de-risk and re-risk the portfolio. And finally, strategies like ours rely on fundamentals. And so for us, what we look to do is to invest in the handful of asset classes that are showing promise to deliver higher returns with lower risk. So what we mean by that is we look at 80+ asset classes. Of those 80+ asset classes, we expect at any given time there will be 10 to 15 of these asset classes that exhibit those qualities. And the characteristics that we're looking for are asset classes that are priced attractively relative to their forward-looking fundamentals from the bottom up, as well as reasons why those assets will move towards those fundamentals over the next 9 to 18 months. So these are generally top-down type of reasons, such as what's happening with policy and politics, where are we in the business cycle. All of these can be very important in terms of identifying both those asset classes that have top-down and bottom-up characteristics that are likely to achieve that higher risk-adjusted returns.